Target sees slowdown but is still a strong retail buy by Travis Hoyam, August 22nd, 10:14 a.m.
Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Target reported fiscal second quarter earnings before the market opened on Wednesday, and the result.
Look at this guy's eyes. It looks like he just smoked a big fatty, doesn't it?
It's really a mixed bag, but the stock is up about 4%. So I want to cover exactly what's going on, what the big.
Looks like he smoked a big fat blunt. Look at his eyes. Look at his eye right there. Maybe he just got pink eye.
Trends are, because there's some changes in retail over the last year or so that we should keep in mind, especially when it comes to comparing it to the results at Target. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you like this video, check out my newsletter, Asymmetric Investing, in the show notes. And I'm going to go straight to the earnings release from Target. I'm going to start with the statement of operations, or the income statement. The one thing to keep in mind is that same-store sales were down 5.4%. So that's why you see, we start on the top line here, sales overall were down 4.9%. So there's a few stores added. That's why overall sales not quite down as much as same-store sales. But if we go down to cost of sales, or cost of goods sold, that was down 11.6%. As a result, operating income was actually up sharply, nearly 300%. So what's going on here is that you might remember a year ago, Target basically had the wrong inventory. As we came out of the pandemic, they had prepared for people buying things like home furniture, stuff that they were buying when they were staying at home more during the pandemic. But people were starting to go back to work. So they had to discount those products and sell them off, sometimes at a loss. Clear through that inventory, that resulted in a couple of pretty weak quarters. And what we're seeing right now is Target coming out of that. So despite the fact that revenue was down in the quarter, we actually see income going up. But that's the reason behind that. From an earnings perspective, net income up 357% to $835 million, or $1.80 per share. You can see some of the changes in those inventory movements that I talked about earlier. $12.7 billion worth of inventory. A year ago, that was $15.3 billion worth of inventory. So a big change in inventory, and that's a big reason in the increase in operating income. If we go down to the statement of cash flows, this is for the 6 months ended July 29th, but you can see that there's $3.4 billion worth of cash from operations, and then $2.8 billion worth of capital expenditures. So overall, cash and equivalents at the end of the period after paying a dividend, reducing long-term debt a little bit, $1.6 billion versus $1.1 billion a year ago. Some of the trends in the operating results were really interesting. Here you get a little bit of the gross margin and SG&A expense rate. So like I said earlier, gross margin was up pretty sharply, now 27%. SG&A, which is operating costs, were up. That's partly because revenue was down, so nothing to be too alarmed by, but just keep that number in mind because we do want to see some operating leverage when Target starts to grow again. Comparable same-store sales down 5.4%, and the driver there was fewer transactions. If we look at the sales by channel, the shopping actually in-store was only down 4.3%. That's this number right here. And then digital sales, which is drive up, pick up, and shipped, were down 10.5%. So what's going on is that people are actually going into the store more than they were previously. Remember that those digital channels grew tremendously during the pandemic. So there may be some shifting back to the way people used to shop, but there is absolutely overall a shift to this new digital type of shopping and on the Target app. So I think that's generally a positive trend, but it's not going to be growing in a straight line. So that's why we see some of the ebb and flow there in the numbers. From a stock standpoint, why were shares up today? Well, the big reason is there was this big drop in May. You might remember during Pride Month, Target had some controversy there. I don't need to go over that here, but the fear from Wall Street's perspective is that there was going to be a big backlash and a drop in sales, a lot like we've seen at Budweiser. That did not appear to happen, at least in a big way, maybe a couple of percentage points of sales, but those customers did start to come back. Now, management does expect revenue to decline this fiscal year, so the trends are not moving in the right direction, but Like I said before, not as bad as was previously anticipated. And as I'm recording, the stock is up about 4%, was trading even higher than that earlier today. So that's the reason for the price action over the last couple of months. The general trends to think about is that consumers are just generally spending less on retail than they were a year ago. So we've seen falling results from Target, we've seen that at Home Depot. Consumer trends are shifting. And one of the concerns that has been brought up is that now with student loan repayments starting in the next month or two, we could see even more pressure on consumers.
And I've mentioned this before. I mean, uh, the the middle class in America has been eroding away for a while, and Target is a upper middle class to upper middle class store. um, People with assets, it really shouldn't affect them much because their assets go up with inflation if they have real estate or they have stocks or whatever. But the poor people and the lower middle class, they basically have no assets, and they're spending more money on food, they're spending more money on rent, or mortgages, they're spending more on gas. And then, I had mentioned this before about the student loan, $1.7 trillion in student loan. Not to mention a trillion in credit card, and people are paying 20%. And as you guys know, if you can compound money at 20%, you're going to be very rich very quickly. And unfortunately, the opposite is true too. Basically, we're all making the banks rich, and we're getting killed in the process.
Add in the fact that interest rates are up, auto loan rates are up, mortgage rates are up. Everything is getting more expensive. Does that pinch consumers at a place like Target? It appears that management is at least preparing for that. So that's one of the reasons to be a little bit cautious. But I think operationally, the positive is that Target is returning to profitability and better margins that we saw a year ago after some of those inventory challenges. So that's why I said this is a mixed bag from a results standpoint. You don't want to see revenue falling in a retailer, but it's understandable why that's happening from a macro perspective. There was some Target self-inflicted wounds there, but I think going forward, this is going to be a company that's going to just grow steadily and surely as retail sales grow. And we did see strong margins at Target. So the company...
But, I think the gay rights thing was very stupid, and some of those people will probably never come back. But I don't think it's as bad as Budweiser, for example. And then the other self-inflicted wound was they made stupid decisions as far as inventory goes during the pandemic, and overbought inventory, and then they had to either sell it at a very sharp discount or even at a loss. But yeah, if their profits were up 300%, that's a good thing. And I think anybody who bought it buys it at today's price, in the next 10 years or so, will more than likely probably double their money in the next 10 years. Although in the short term, I still think it's probably going to go down in the short term, but long term, I think it'll be okay. Anyway, thanks for watching.